The Ansoff matrix is a very popular tool within the analyst community for assessing a company's strategy. It's sometimes called the product market expansion grid. It's a 2x2 framework that helps stakeholders visualize the relative attractiveness and risk between growth strategies that are commonly employed by management teams. The matrix plots products on the x-axis and markets on the y. It asserts that a business can either use existing or new products and can deploy them into existing or new markets. These are, in essence, the only levers a management team can pull to achieve growth. Regardless of the firm's competitive advantages or competitive positioning, it needs to sell something to someone. For context, markets could mean a physical geography, like North America or South Asia. It could also mean a target market, perhaps a demographic like women aged 30 to 40, or a target audience like young professionals working in the knowledge economy and living in urban metros. The strategies are market penetration, market development, product development, and diversification. Market penetration is increasing sales of existing products into existing markets. A common example is telecommunications. These firms are notorious for undercutting one another to gain greater domestic market share, using introductory rates and other promotional efforts to attract customers away from competitors. Market development is when management teams seek to sell existing products into new markets. Consider a clothing brand that's popular in North America looking to start selling into the European market. The product development growth strategy is where management teams look to create new products, then sell them into existing markets. Successful product development initiatives sometimes play on brand loyalty, like Apple creating AirPods. This was a new product, but it was widely embraced by a very loyal existing customer base. Diversification, on the other hand, is when a firm looks to create an altogether new product for an altogether new market. This is the riskiest of the four strategies, since successful execution requires both product and market development. As with anything in business, there's never a one-size-fits-all solution, and even the best and most appropriate strategies can fail because of bad execution. So there's more to analysis than just understanding a firm's strategy. Nevertheless, Ansoff's matrix helps analysts start to quantify the level of risk in a management team's expansion strategy. Now it's time to pull it all together using a SWOT analysis, which stands for strengths, weaknesses, opportunities, and threats. While the SWOT is itself an assessment framework, it's also something of a summary exercise. See, with SWOT, we examine the findings from the other frameworks that were covered earlier in order to highlight intrinsic features of the business, which are its strengths and weaknesses, as well as external features, or opportunities and threats. Strengths are, of course, characteristics that give the business a competitive advantage. Strengths include, but are not limited to, a good reputation, massive brand awareness, best-in-class margins, pricing power, an experienced management team, and so on. Weaknesses are the opposite. These are characteristics that put a business at a disadvantage relative to its competitors. They include inexperienced management, cyclical sensitivity, a cost structure that is out of line with industry norms, or other financial metrics that are weaker than benchmarks. This is by no means an exhaustive list, by the way. Opportunities represent elements in a company's external environment that allow it to formulate and implement growth strategies, whether that's revenue expansion, increased profitability, or otherwise. Opportunities may include potential acquisitions, mergers or divestitures, as well as a growing total addressable market, often called TAM, or potential product or market expansion strategies, as per Ansoff. Threats, of course, are the opposite. What elements of the external environment might endanger a business or impact its ability to operate as a going concern. Threats include, but are certainly not limited to, significant disruption within the industry or the economy, usually technology-related, changes in social trends that might adversely affect market size or appetite for the product or service, think social factors, or even risks associated with actual or potential environmental issues. As you've probably identified, the opportunities and threats facing a company become much clearer after conducting a thorough Pestel analysis, which is why it's such an important tool in understanding the business environment. If you've found your way to Corporate Finance Institute and you've made it this far in the course, it's probably reasonable to assume you have some interest in financial analysis. Now remember, financial analysis is always conducted with an end goal in mind. A different way to think about it is to ask yourself, what's the question I want answered? Nobody builds a model and conducts extensive due diligence just for fun. They want to answer a question. For example, you might be an equity researcher asking, what's the fair market value of this company's shares? Or are the shares undervalued, overvalued, or fairly valued? In other words, is it a buy, sell, or hold? You might be a lender asking, if we lend money to this company, how likely is it that they'll pay it back? Or maybe, how much money is a reasonable amount to lend? Perhaps you are a private equity analyst looking at potential merger or acquisition opportunities within your portfolio. The question could be, would buying or merging with this company be a smart financial decision? In order to answer these questions, an analyst must first be able to assess growth drivers and business risks, as we've covered here. Then they must take these findings and translate them into model assumptions. This is what will help you capture unique economic, industry, or company-level characteristics that may influence success or failure for a business. For this course, I'm going to demonstrate using the Assumptions and Drivers section of a model. As we make changes, they'll flow through this three-statement projection model that we've built, but you'll see in real time here on these charts on the right how revenue, margins, and the company's cash flow are affected. If we look here, these are called spark lines. They're a fun visual tool you can use in Excel to help visualize trends, since looking at many years of projections can sometimes be hard on the eyes. Spark lines are a quick way to get a sense of direction and trend. Please note, this course is not designed to teach you how to model. Although CFI has literally dozens of modeling, accounting, and analysis courses, as well as productivity tools like Macabacus that will help you become a world-class modeler. And we encourage you to try all of these. This course is designed to help learners conceptualize how qualitative analysis can be translated into quantitative analysis by making changes to some of these assumptions. Let's look at a few example mini case studies to demonstrate.